In 2026, how much of your paycheck gets taxed for Social Security is changing. And for high earners, that could hit your bottom line in a big way. Let's get into what exactly is shifting, why it matters, and what you need to watch out for. All right, first things first. What do we actually mean by taxable maximum earnings? This is the cap, the highest amount of income on which Social Security, OASDI, taxes apply. In simpler terms, if you make more than this number, you don't pay Social Security tax on anything above it. That's super important for folks making big bucks. According to the SSA, for 2026, that cap jumps to $184,500. Here's the big move. In 2025, the cap was $176,100, but for 2026, it climbs to $184,500. That means more of your income can be taxed before you hit the ceiling. According to SSA's fact sheet, the 6.2% OASDI rate still applies up to that cap. For employees and employers, that translates into $11,439 each in Social Security tax for those who hit or exceed that wage base. If you're self-employed, since you pay both the employer and employee portions, you're looking at $22,878, because 12.4% of $184,500. So what's driving this hike? It's not just inflation. It's tied to the National Average Wage Index. SSA uses that to set how much of people's earnings should be subject to Social Security tax. As wages go up, so does a portion of income that can get taxed under OASDI, up to that new $184,500 mark. By raising the cap, SSA brings in more contributions from people who make a lot, which helps shore up funds for the Social Security system. That's a pretty big deal for long-term solvency. And yeah, if you're on the high end of the pay scale, you'll definitely feel this. If you don't make close to $184,500, this change probably won't change your life that much. But for high earners, it's real. More of your income will be taxed for Social Security, which means more goes into OASDI, but also more can go into your eventual benefit calculation, depending on your work history. Also, because the cap is increased, the maximum benefit that someone who pays up to the ceiling can earn in future benefits might edge up a little, assuming other factors hold. So it's not just a cost, there could be a benefit too. Here's where you gotta be smart. If you're a higher income worker, this jump changes your tax planning math. Revisit your paycheck withholding. Make sure you're not under or over withholding based on the new cap. If you're self-employed, run the numbers. Higher cap, more self-employment tax. You might need to adjust your quarterly estimated payments. Think about your long-term Social Security strategy. More contributions now could mean more back later, but only if you stick to a plan. Talk to Financial Pro. This is a no big deal change for folks in high tax brackets, especially if you're relying on future Social Security benefits. This change of the wage base isn't happening in a vacuum. Along with the cap bump, there's a 2.8% COLA for 2026. That means benefits go up, but so do costs, and higher income earners will contribute more due to the raised cap. Plus, the earnings test limit, if you're working while collecting benefits, is changing. For those below full retirement age, the 2026 limit is $24,480. That's another piece of the puzzle for folks balancing work and retirement. Bottom line, $184,500 is the new cap for 2026. And that matters whether you're working now, planning retirement, or trying to maximize your benefits. If you're making bank, this new threshold changes how much Social Security tax you pay and what you might get back later. If you found this breakdown helpful, hit that like button, subscribe for more Social Security updates,